Forex, Fundamentals and Trading. Chapter 1. Introduction to Forex Markets. Section 1. What is Forex? Forex, short for foreign exchange, is simply the process of converting one currency into another. Even people who never place a trade still use the Forex market all the time, often without thinking about it. If you travel abroad, pay an overseas supplier, receive revenue from another country, or invest internationally, some kind of currency exchange has to happen in the background. That is why Forex is not just a trader's market. It is a core part of how the global economy functions. Every cross-border payment depends on the ability to move value from one currency system into another. So before thinking about speculation, it helps to see Forex first as the plumbing of international commerce and finance. Unlike stocks, Forex does not trade on one central exchange building where everyone sees one official price. It operates as an over-the-counter or OTC market, which means prices are created through a network of banks, brokers, and other institutions trading electronically with one another. This network stretches across major financial centers such as Sydney, Tokyo, London, and New York. As one region winds down and another becomes more active, trading continues through the global week. That is why Forex is often described as a 24-hour market for 5 days a week. The key idea is that Forex is decentralized, but still highly connected through electronic pricing and order flow. In Forex, currencies are always quoted in pairs because one currency only has meaning relative to another. If you see euros (USD), you are looking at the value of the euro compared with the US dollar. The first currency, euro, is called the base currency, and the second, USD, is the quote currency. Buying the pair means you are buying the base currency and selling the quote currency at the same time. Selling the pair means the opposite. You are selling the base and buying the quote. This two-sided structure is one of the most important habits to learn early, because every Forex trade always contains both sides of that comparison. A Forex quote tells you how much of the quote currency is needed to buy 1 unit of the base currency. For example, if euro/USD is 1.1050, that means 1 euro costs 1.1050 US dollars. If you buy euros/USD, you are choosing to own euros relative to dollars. If you sell euros/USD, you are choosing to own dollars relative to euros. This sounds simple, but many beginner mistakes come from forgetting which side is the base and which side is the quote. If you stay anchored on the sentence 1 euro equals 1 tate and $50, the quote becomes much easier to interpret. Most Forex prices are shown with 2 numbers rather than 1, the bid and the ask. The bid is the price at which the market will buy from you, and the ask is the price at which the market will sell to you. So if the quote is 112.80 by 112.83, you sell at 112.80 and buy at 112.83. The difference between those two prices is called the spread, and in this case it is 0.0003. That spread is one of the basic costs of entering a trade. Even before the market moves, a trader begins slightly behind by that amount. The Forex market includes a wide range of participants, and they do not all show up for the same reason. Central banks influence currency markets through interest rate policy, communication, and sometimes direct intervention. Large commercial and investment banks handle major currency flows for clients and for their own trading activity. Corporations exchange currencies to pay suppliers, receive foreign revenue, or reduce business risk. Investment funds and retail traders may enter the market to hedge, invest, or speculate on price movements. Seeing these different motives helps explain why Forex is both a practical market and a speculative one at the same time. Forex is known for liquidity because it is the largest financial market in the world, with daily trading volume above $7 trillion as of 2024. Liquidity means you can usually trade quickly without moving the price very much, especially in major pairs like euros/USD/JPY. In a deep market, there are many buyers and sellers active at the same time, which helps orders get matched efficiently. That often leads to tighter spreads and smoother execution under normal conditions. But liquidity is not a promise that price will stay calm. During major news or stress, even a very liquid market can move sharply. Exchange rates move because markets are constantly reassessing the relative strength of one currency against another, Interest rates are a major driver because higher yields can attract capital and support a currency. Inflation, jobs data, growth reports, and other economic releases also matter because they affect expectations about future policy and economic strength. Central bank decisions and guidance can move currencies even before a rate change actually happens. Geopolitical events and shifts in market sentiment add another layer, especially when traders become more cautious or more confident. In other words, Forex prices respond not just to facts, but to changing expectations about what comes next. A simple currency conversion example makes exchange rate risk easier to see. Suppose you start with 1000 US dollars when USD-JPY is 150. So you receive 150 taus yen. If you hold that same yen amount and later the rate moves to 152, converting back gives you about $906.84. You still have the same number of yen, but those yen now buy fewer dollars than before. This shows that exchange rate changes can alter value even when the foreign currency amount stays unchanged. In Forex, what matters is not just how much you hold, but what that amount is worth relative to another currency at the time you convert. Businesses deal with Forex risk whenever they earn, pay, or report value in different currencies. Imagine a company agrees to a sale worth 500 1000s. If USD is 100, 1800 when the deal is priced, that revenue looks like 540,000 ZS fall into 1 jur. 05 there, the same euro sale converts to only 525 $1380. Nothing changed about the contract amount in euros, yet the company receives 15,300 dollars. That is why many firms hedge currency exposure, not to speculate, but to protect the value of future cash flows. At this stage, a few habits are worth locking in early. Every Forex trade has two sides, so always ask which currency you are buying and which one you are selling. Keep base and quote currencies clearly separated in your mind, because confusion there leads to bad decisions later. Remember that you buy at the ask and sell at the bid, which means the spread matters from the moment you enter. And just because a market is liquid does not mean it is low risk. Those ideas may seem basic, but they form the foundation for reading quotes correctly and thinking clearly about trades. Section 2. How currency markets work. To understand how currency markets work in practice, start with the idea of a global electronic network rather than a single location. Forex trading happens through connected banks, brokers, and trading venues spread across the world. The market stays active through the week as participation shifts from Sydney to Tokyo to London to New York. Because of that rolling handoff, prices can update almost continuously across the trading day. That constant activity is one reason Forex attracts both businesses and traders. It also means conditions can change while you sleep, because the market does not depend on one country's business hours. Every Forex trade is built around a currency pair, because you are always comparing one currency with another. In a quote like Euro/USD, Euro is the base currency, and USD is the quote currency. If the pair is trading at 1.50, that means 1 euro is worth 1.50. That means 1 euro is worth 1.50. The rate is not describing the euro alone or the dollar alone. It is expressing their relationship. This is why Forex is often called a relative value market. A pair rises when the base currency strengthens relative to the quote, and falls when the opposite happens. When you buy or sell a pair, the action tells you which currency you are taking exposure to. Buying Euro/USD means buying euros and selling dollars, so you profit if the pair rises after your entry. Selling Euro/USD means selling euros and buying dollars, so you profit if the pair falls after your entry. Notice that both actions revolve around the base currency, which is euro in this example. The quote currency helps express the price, but the trade direction is defined through the base. That is why many traders say you are always trading the base currency, just in relation to the quote currency. A typical Forex quote shows both a bid and an ask, and that small gap between them matters. The bid is the price at which you can sell the base currency, and the ask is the price at which you can buy it. If Euro/USD is 1.1050 by 1.1052, the spread is 0.02 or 2 pips. If you buy at 1.1052 and immediately close the trade, you would sell back at 1.1052 and immediately close the trade, you would sell back at 1.1050 and take that small loss. That is why traders say you begin slightly negative when you enter. The market must move far enough in your favor to overcome the spread before the position becomes profitable. Spreads are not fixed forever. They expand and contract with market conditions. Major pairs usually have narrower spreads because they attract more trading activity and deeper liquidity. Exotic pairs often have wider spreads because fewer participants are quoting them actively. Spreads can also widen sharply during major news events when uncertainty rises and pricing becomes less stable. Thin trading periods, such as quiet session transitions, can have a similar effect. So when a trader looks at cost, it is not enough to know the pair alone. The timing and market environment matter too. Forex participation is layered with the interbank market at the top of the structure. Major banks provide much of the market's core liquidity by trading directly with one another and with large clients. Institutions such as hedge funds, asset managers, corporations, and central banks enter for different purposes, including hedging, investing, or policy actions. Retail traders usually do not access the interbank market directly. Instead, they trade through brokers, which connect them to liquidity in different ways. Understanding this hierarchy helps explain why not every participant gets the same pricing or execution quality. Leverage is one of the defining features of Forex trading, and it can be both useful and dangerous. It allows a trader to control a larger position with a smaller amount of posted capital called margin. For example, at 50-to-1 leverage, $1,000 of margin can control a $50,000 position. That increases exposure, which means even a small market move can create a large percentage gain relative to the margin used. But the same math works against you when the trade moves the wrong way. Leverage does not make the market move more. It makes your account feel the move more intensely. A Forex trade follows a fairly clear sequence from start to finish. First, you choose a currency pair and read the current bid and ask. Then you decide on trade size, often in standard mini or micro lots depending on your account and risk plan. After that, you place the orders through your broker's platform and wait for execution. When you later close the position, you do so with the opposite action. A buy is closed with a sell, and a sell is closed with a buy. The final profit or loss depends on the difference between entry and exit, adjusted for trade size and trading costs. The price you see on screen is not always the exact price you receive. In fast markets, your order may be filled at the current available market price, which can differ slightly from the quote that first caught your eye. That difference is called slippage. For example, if you expected to buy at 110.50 but were filled at 110.53, the 0,003 gap is slippage against you. Low liquidity and high volatility make this more likely, especially around data releases or sudden headlines. So execution quality is an important part of trading, not just the direction of the market. Consider a simple leverage trade in Euro/USD. Suppose you buy one mini lot, which is 10,000 Euro00s, at an ask price of 1.1052. The notional value of that position is 11,052 tons, but at 50-to-1 leverage you only need about $221.04 of margin to open it. If you later exit at 1.1080 bid, the move is 28 pips in your favor. On a mini lot, that works out to about $28 in profit. That can look attractive relative to the small margin used, but a 28 pip move against you would create a very similar loss just as quickly. Good trading habits usually come from reducing avoidable mistakes before the order is even placed. Be clear about base and quote currencies so you know exactly what you are buying or selling. Include the spread in your thinking, because it is part of the cost from the start. Use leverage carefully, since small price moves can become large account swings when position size is too big. And most important, set your size, stop loss, and target before entering rather than improvising once emotions rise. Clean planning does not remove risk, but it makes your decisions more deliberate and far more consistent. Section 3. Why currencies move. Currencies move on relative expectations, not in isolation. In a pair like Euro/USD, the price reflects what the market believes about both the euro area and the United States at the same time. If traders become more optimistic about Europe, while also becoming less optimistic about the US, Euro/USD may rise sharply. If the opposite happens, the pair may fall even if nothing dramatic changes in one region alone. That is why Forex analysis is always comparative. A currency pair is really a live scoreboard of shifting views about two economies, two policy paths, and two sets of risks. Most currency moves can be traced back to three broad forces working together. The first is interest rates and central bank policy, because money tends to favor higher expected returns. The second is economic data, especially when reports come in stronger or weaker than forecast. The third is market sentiment, which affects whether traders are comfortable taking risk or prefer safety. Sometimes these forces point in the same direction and create a strong move. Other times they offset each other, which can lead to choppy, confusing price action. Interest rates are often the strongest longer-term driver in Forex because they influence where global capital wants to go. If one country offers higher yields than another, its currency may become more attractive to investors. Rate cuts can have the opposite effect by reducing that appeal. But markets do not wait only for official decisions. They also react to central bank language, tone, and guidance. In many cases, currencies start moving well before the meeting because traders are pricing in what they expect to happen next. So in Forex, expected future policy can matter as much as current policy. Economic data moves markets most when it changes the story traders were already expecting. Reports like GDP, jobs, and inflation help markets judge whether an economy is strengthening or weakening. Strong data can support a currency, especially if it reduces the chances of future rate cuts or raises the odds of tighter policy. Weak data can do the opposite by making a central bank seem more likely to ease. The crucial point is that markets compare actual results with forecasts, not just with last month's number. A report that looks good in isolation may have little impact if traders already expected it. Sentiment can drive fast currency moves even when no scheduled data release is due. In a risk-on environment, traders may favor growth-linked or higher-yielding currencies because confidence is improving. In a risk-off environment, money often shifts toward currencies seen as safer, such as the US dollar, Japanese yen, or Swiss franc. Headlines can trigger these shifts very quickly, especially when they affect global growth, conflict risk, or financial stability. Stock markets and volatility measures often influence these flows as well. That is why currencies sometimes move sharply on mood and positioning, not just on formal economic numbers. Unexpected shocks can push Forex markets into a period of rapid repricing. Elections, trade disputes, sanctions, military conflict, and natural disasters can all change the outlook for growth, inflation, trade, or political stability. When that happens, traders may rush to reassess risk and reposition their exposure. The result is often wider price swings and more volatile trading conditions. Even if the long-term impact is unclear, uncertainty alone can be enough to move currencies sharply. Forex is highly sensitive to events that change confidence or alter expectations about a country's future path. Some currency drivers act like sparks, while others act more like engines. Short-term catalysts include data releases, central bank remarks, and breaking headlines, and they can move a pair within minutes or hours. Longer-term drivers include trends in interest rates, inflation, growth, and policy differences between countries. A single surprise may create a sharp spike, but a lasting trend usually needs broader support from these bigger forces. This distinction helps traders avoid confusing temporary noise with a meaningful directional shift. Strong Forex analysis often asks two separate questions: what can move the pair today, and what can sustain it over the next few weeks or months? A major data release often moves the market through a sequence rather than a single instant reaction. First, the number comes out and traders compare it with the forecast. Then they interpret what that surprise might mean for central bank policy or economic momentum. Orders hit the market quickly as traders and algorithms respond to that interpretation. After the first wave, related pairs and broader markets may begin to react as well. Finally, traders reassess the details, such as revisions or hidden weaknesses, and the initial move may either continue or reverse. That is why the first move after a release is not always the final one. A Forex pair moves according to relative surprise, not just absolute news quality. Imagine USD CAD starts at 134.00 and Canadian jobs data comes in much stronger than expected, while US data merely meets expectations. Even though the US side is not weak, the bigger surprise is on the Canadian side. Traders may then expect the Bank of Canada to sound relatively firmer than the Federal Reserve, which supports the Canadian dollar. Because USD CAD measures US dollars in Canadian dollars, stronger CAD tends to push the pair down. In this example, that relative shift could pull USD CAD from 134.73 to 134 to 132.30, a 120 pip move. Forex price moves can look small on a chart, but they can have a big financial effect once leverage is involved. A move from 1.1 thousand to 1.15 may seem tiny, yet that is still 15 pips. On a modest position, that might be manageable, but on a heavily leveraged trade, it can produce a significant gain or loss very quickly. Fast markets can make this even more dangerous because spreads may widen and fills may slip during major releases. That combination of leverage and execution risk is why risk control matters so much in Forex. Position size, stop placement, and awareness of the calendar all become more important when volatility is likely. A practical way to prepare for a data release is to plan the reaction before the number comes out. Choose one release from the US and one from the Euro area. Then write down the current Euro/USD price. After that, define what kind of result would be bullish or bearish for each side of the pair. For example, stronger Euro area data or weaker US data might support Euro USD, while the reverse could weigh on it. Once the release hits, compare the actual market move with your plan and ask what else may have influenced it, such as positioning, headlines, or central bank comments. This habit trains you to think in scenarios instead of reacting emotionally in real time. Section 4. Forex versus stocks. Forex and stocks are both tradable markets, but they are built on different foundations. A stock represents ownership in a single company, while a Forex trade represents the exchange rate between two currencies. That difference affects everything from trading hours to analysis style to risk management. Stock traders often focus on company earnings, management, and sector trends. Forex traders pay more attention to rates, inflation, macroeconomic data, and relative strength between economies. So even when both markets involve charts and price movement, the structure underneath them is very different. Liquidity is often deeper in major Forex pairs than in most individual stocks. The Forex market trades more than $5 trillion a day, and major pairs like Euro/USD tend to have large continuous order flow. That usually supports tighter spreads and faster execution under normal conditions. Stocks can also be very liquid, especially large cap names, but liquidity varies much more from one company to another. A popular blue chip stock and a thinly traded small cap can feel like completely different markets. In practice, that means execution quality in stocks depends heavily on the specific name, while major Forex pairs are more consistently liquid. Trading hours are one of the clearest practical differences between these two markets. Forex trades around the clock during the business week, as activity moves across major global sessions. That gives traders more flexibility if they live outside one country's market hours or prefer to trade at different times of day. Stocks, by contrast, mainly trade during the exchange's regular session, with pre-market and after-hours activity often being thinner. Thinner trading can mean wider spreads and less reliable execution. So access is not just about when a market is open, but also about how good the trading conditions are during those hours. Leverage changes both capital use and risk, and Forex often allows much more of it than stocks. In Forex, a relatively small deposit can control a much larger position through margin. That lowers the upfront capital needed to participate, but it also makes losses grow faster when the market moves against you. Stock margin is usually more restrictive, so traders often have to post a larger share of the position value themselves. The result is that Forex can look more capital efficient on the surface, but higher efficiency is really just higher exposure, and exposure always cuts both ways. The information that moves stocks is not always the same information that moves currencies. Stocks often react to earnings, product announcements, management changes, and industry developments. Forex reacts more to interest rates, inflation, employment data, growth expectations, and central bank guidance. That means a trader who enjoys company research may feel more at home in stocks, while someone comfortable with macroeconomics may prefer Forex. Both markets require analysis, but the type of analysis differs. Matching your market to your strengths can matter as much as learning the mechanics of the trade. Trading costs look different in Forex and stocks, but in both cases, the visible price is not the whole story. In Forex, costs are often built into the spread, though some brokers also charge commissions. In stocks, a trade may appear commission-free while still carrying costs through spreads, fees, and slippage. During quieter stress conditions, those hidden costs can expand quickly. A trade that seems cheap at entry can turn expensive if execution quality deteriorates. So the real cost of trading is better thought of as spread plus commission plus fees plus slippage, not just the number advertised on the platform. A stock trade and a Forex trade ask different core questions. When you buy a stock, you are generally asking whether one company will perform well and whether its share price will rise. When you buy euros/USD, you are buying euros and selling dollars at the same time. That means Forex is always a relative value trade between two sides. You are not just asking whether the euro is strong, you are asking whether it will be stronger than the dollar. This relative structure is one of the biggest mental shifts for traders moving from stocks into Forex. Trade setup and position sizing also work differently across these markets. Stock positions are usually measured in shares, so a trader might buy 100 or 500 shares of a company. Forex positions are commonly measured in lots, with a standard lot equal to 100,000 of the base currency, a mini lot equal to 10,9000, and a micro lot equal to 1,009. Because of leverage, the margin required to hold a Forex position may be much smaller than the full notional value of the trade. That can make the position feel easier to open than it really is. So sizing in Forex requires careful attention to notional exposure, not just the cash posted. Two trades can produce the same dollar profit while involving very different structures and risks. Imagine a stock trader with a $10,200 account buying 100 shares at $100 and selling at $110. That creates a $1,000 gain. A Forex trader with the same account might use margin to control a much larger USD position and also earn about $1,000 from a 100 pip move. On the surface, the result looks similar, but the stock trader used the full capital directly, while the Forex trader controlled a larger notional position with less posted capital. That difference matters because the same leverage that helps create the gain can also magnify losses just as quickly. Neither Forex nor stocks is automatically the better market. Forex offers flexibility, deep liquidity in major pairs, and strong opportunities for traders who follow macro themes closely. Stocks offer direct company exposure and may suit traders who prefer earnings analysis and business-specific research. The better choice depends on your schedule, your analytical strengths, and your discipline with risk. A trader who cannot manage leverage well may struggle in Forex, while someone uninterested in company news may struggle in stocks. In both markets, good habits matter more than the label on the instrument. Section 5, Market Structure Overview. To wrap up the chapter, it helps to look at the market structure underneath everything we have discussed. Forex is a layered over-the-counter market, not a centralized exchange with one trading floor and one official quote. Prices are formed through a network of banks, brokers, institutions, and other participants trading electronically with one another. Because the market is decentralized, different participants may see slightly different prices at the same time. Access depends on where you sit in that network and who connects you to liquidity. This is one reason retail traders should not expect to experience the market exactly the way a top-tier bank does. A simple way to picture Forex structure is in tiers. At the top is the interbank market, where the largest institutions trade directly and usually receive the best pricing. In the middle are brokers and distribution channels that pass liquidity from top-tier participants to smaller institutions and clients. Lower down are end users such as businesses, smaller institutions, and retail traders. As access becomes less direct, spreads often become wider, and execution quality can change. So the tier you trade through helps shape both what price you see and what trading costs you face. Tier 1 is the interbank market, where the largest global banks trade directly with one another, often in very large size. This is the area of the market closest to price formation in major currency pairs. Quotes move through institutional platforms such as EBS and Reuters matching, where top-level participants can transact efficiently. Because of the depth of liquidity and the relationships involved, spreads here are usually the tightest under normal conditions. But access is limited and depends on credit lines, counterparties, and institutional relationships. In other words, this is not the version of the market most retail traders see. Tier 2 sits between top-tier liquidity and the broader market. Prime brokers, ECNs, aggregators, and retail brokers take prices from higher-level sources and distribute tradable quotes to smaller institutions and individual traders. This layer is essential because it extends access to participants who cannot deal directly in the interbank market. Brokers may combine quotes from several providers, add a markup, charge a commission, or do both. That means the price shown to a client is often a packaged version of underlying market liquidity. For most retail traders, this middle layer is the real gateway to Forex. Tier 3 includes participants who often use Forex for policy or practical business reasons rather than short-term speculation. Central banks may enter the market to influence financial conditions, manage reserves, or stabilize a currency during periods of stress. Businesses exchange currency to pay suppliers, collect overseas revenue, or hedge future cash flows. These participants may care less about short-term chart patterns and more about operational needs or broader economic goals. Smaller end users in this tier often face wider spreads because they are farther from top-tier liquidity. Their goal is usually efficient completion of a real-world task, not necessarily capturing the best institutional price. By the time a Forex quote reaches your platform, it is usually passed through several steps. Banks quote each other first, and electronic venues display the available prices in the wholesale market. Aggregators and brokers then collect that liquidity, choose how to present it, and build the final bid and ask offered to clients. In some cases, your broker may route the order externally. In others, it may internalize the trade depending on its model. That is why the quote on your screen is not a raw universal market truth. It is the tradable price your broker is able and willing to show you at that moment. There is no single universal Forex quote because each participant connects to the market differently. Different brokers may use different liquidity providers, face different risk limits, hold different inventory, and manage different client flows. As a result, two platforms can show slightly different Euro/USD prices at the same time. Higher tier access usually brings tighter spreads, while retail and many business users typically pay more. During stress, these differences can become more obvious because retail spreads often widen first. So, quote differences are not necessarily errors. They are a normal feature of a decentralized market structure. The same market can produce meaningfully different prices for different participants. One interbank participant might see 1.0999 by 101. A retail broker might show 1.0998 by 103. And a regional bank might quote 1.093, and a regional bank might quote 1.0995 by 108. All of those prices can exist at nearly the same moment for the same currency pair. The difference is largely explained by access level, liquidity source, and the cost of distributing that liquidity. The farther a participant is from top-tier pricing, the wider the spread is likely to be. This is one of the clearest examples of how market structure directly affects the trader's experience. Not all market participants influence prices equally. Large banks and other major liquidity providers help shape prices most directly because they sit close to the center of the trading network. Central banks can also have powerful influence through policy decisions, communication, and intervention. Brokers mainly distribute available prices rather than set the global market on their own. Retail traders and most businesses are usually price takers, meaning they accept the market prices offered through their access channel. So exchange rates emerge from continuous network activity, but pricing power is concentrated more heavily at the top of the structure.